This is Paris Hoover, your Patton University online course instructor for this semester, Unit 2, Introduction. Most investors are familiar with the idea of a stock exchange. A stock exchange allows investors to buy and sell shares of stock ownership from companies wishing to obtain investor capital. Stock may be traded on national, regional, or over-the-counter stock exchanges. Most common form of stock investment is common stock. A share of common stock represents a portion of ownership in the issuing company. The investor assumes full risk and is not guaranteed dividends or any return on the investment. Some companies also choose to issue preferred shares of stock. Preferred stock comes in many varieties, but is generally more expensive and less risky than common stock. Holders of preferred stock are more likely to see dividend income than holders of common stock. In the financial markets, regulation is critical. There are far too many opportunities for malpractice and misrepresentations. Management of companies may be tempted to make their stock appear to be more attractive investment than it really is. If advisors are accepting commissions or other compensation, they may be tempted to sell an investor's stock or another investment that is not really the individual's best interest. International rules and regulations help to ensure that corporate management and financial advisors follow certain rules and regulations when it comes to investing. To help promote their financial well-being, investors may choose to invest in mutual funds or a variety of retirement accounts. Mutual funds are a great way for investors to invest in a relatively small amount of money, but still have a diversified portfolio. With mutual funds, the monies of many investors are pooled to purchase a variety of investments. Each investor enjoys minimal risk and administrative responsibility. Similarly, most workers seek some sort of retirement plan or savings to provide them with financial security during their retirement years. In this unit, you will learn more about the topics above as you explore them through readings in your textbook, articles, and a number of engaging videos. Learning objectives. 1. Identify the different stock trading systems, types of shares, and stock indices. 2. Evaluate the role and drawbacks of international investment regulation. 3. Illustrate the characteristics of mutual funds and annuities. Please continue to Objective 1. Chapter 6, Stock Exchanges, pages 117 to 130. The functions of a stock exchange. The main purpose of a stock exchange is the transfer of money from investors to those wishing to obtain capital. The investors buy shares and bonds from issuers and thereby transfer money to them in exchange for potential future cash flows. In the absence of financial intermediary, such as a stock exchange, the direct transfer of money from investors to those wishing to obtain funds would be problematic for a number of reasons. First, there would be the difficulty of how investors and those seeking funds are to find each other. Second, companies and governments want to raise large amounts of capital, whereas individual investors normally want to invest relatively small sums. Individual investors have limited sums to invest, and they usually prefer to spread their investments amongst a number of companies so as to avoid the risk of suffering heavily from the poor performance of one firm. A stock exchange provides size transformation. Relatively small sums from a large number of investors are aggregated so as to provide a large sum for the firm or organization raising capital. Third, stock exchanges provide maturity transformation. Companies need to obtain funds for the long term, whereas investors typically want immediate access to their money. A stock exchange provides a means of reconciling these two objectives. A firm may sell securities with distant maturities, whilst the buyers of such securities can obtain quick access to their money by selling the securities. Another function of a stock exchange, which is performed as a byproduct of the financial intermediation, is to communicate information about the companies whose securities are being traded. The prices of stocks and bonds reflect the evaluation of investors and dealers of performance of the firms. Share prices and their changes can communicate information of value to those inside as well as those outside the companies whose shares are being traded. Primary and secondary markets. When stocks and bonds are initially issued, they are said to be sold in the primary market. Subsequent to their initial sale, they are traded in the secondary markets. Primary trading involves buying and selling newly created securities, whereas secondary trading involves shares and bonds that are already in existence. The fact that financial investments can be sold in a secondary market renders them more liquid and hence more attractive. This enhanced liquidity makes investors more willing to buy in the primary market, and causes them to be less demanding in terms of required rates of return. An active secondary market improves the operation of the primary market and allows companies to raise money easily and on favorable terms. Secondary market trading volume far exceeds the level of primary market dealing. The secondary market is the market in which previously issued securities are traded. It is the means by which stocks or bonds bought in the primary market can be converted into cash. The knowledge that assets purchased in the primary market can easily and cheaply be resold in the secondary market makes investors more prepared to provide borrowers with funds by buying in the primary market. A successful primary market depends upon the effective secondary market. If transaction costs are high in the secondary market, If transaction costs are high in the secondary market, the proceeds from the sale of securities will be reduced, and the incentive to buy in the primary market would be lower. Also, high transaction costs in the secondary market might tend to reduce the volume of trading and thereby reduce the ease with which secondary market sales can be executed. It follows that high transaction costs in the secondary market could reduce that market's effectiveness in rendering primary market assets liquid. In consequence, there would be adverse effects on the level of activity in the primary market and hence on the total level of investment in the economy. Price volatility in the secondary market might also be detrimental to the operation of the primary market. High volatility means that buyers in the primary market stand a considerable risk of losing money by having to sell at a lower price in the secondary market. This can reduce the motivation to buy in the primary market. Two factors that affect the price volatility of securities in the secondary market are the depth and breadth of that market. The depth of the market is based on the likely appearance of new orders stimulated by any movement in price. If a rise in price brings forth numerous sell orders, the price rise will be small. A decline in price that stimulates many buy orders would be a small decline. A deep market would be characterized by the appearance of the orders that tend to dampen the extent of any movement in the price. Greater depth is thus associated with lower volatility. The breadth of the market reflects the number and diversity of the traders in the market. If there is a large number of market participants with differing motivations and expectations, there is less likely to be substantial price changes that would be expected when there is a small number of traders, or when the traders have common views such that they buy or sell together. A broad market is a large heterogeneous market characterized by relative price stability. Stock exchange listing. If a company wants its shares to be traded on the stock exchange, the shares must be listed on that stock exchange. The ability to sell shares on the stock exchange makes people more willing to invest in the company. Consequently, they would accept a lower return on shares, and hence the company can raise more capital more cheaply. The stock exchange also provides a market price for the shares and thereby allows a valuation of the company. Listing requires a substantial amount of documentation from the company, especially in terms of published accounts. The substantial amount of documentation is costly for the company, but it's useful for investors who want detailed information before investing. The information helps to establish the correct share price. More certainty about the correctness of a share price encourages investors and reduces the return that they require. Hence the cost of capital to the company that is reduced. The information aids corporate governance, which entails monitoring the management of the company. This governance is conducted by investors and by the media. A stock exchange listing makes takeover bids easier since the predator company is able to buy shares on the stock market. Please continue reading to page 130. Chapter 7, Stock Indices, page 131 through 144. Types of index. Stock indices are measures of the price performance of stock portfolios, which may be seen as representative of a stock market as a whole or of a segment of the market. The better-known indices include the Dow Jones Industrial Average, the Standard & Poor's 500, and the NASDAQ in the United States, the FTSE 100 in the United Kingdom, the Nikkei 225 in Japan, the DAX in Germany, the CAC 40 in France, and the Hang Seng in Hong Kong. All countries with stock markets have at least one index. Some countries have numerous indices. Indices are not only calculated for national stock markets. There are also regional and global market indices. For example, the FTSE, MSCI, and S&P, and Dow Jones all produce stock indices for both the world as a whole and Europe as a whole. There are often sub-indices, for example, European indices exclusive of the UK. Indices are also calculated for bonds. There are indices of bond yields as well as indices of bond prices. Each bond index relates to a particular type of user and a specific maturity band. This chapter is primarily concerned with the mechanics of the calculation of indices. This is of importance since it determines the comparability of the movements of different indices and the interpretation that can be put upon a change in particular index. Indices can be categorized in a number of ways. 1, the number of stocks included. 2, the method of weighting the stock prices. And 3, the nature of the averaging. The number of stocks can vary from a small number of large company stocks to inclusion of every stock traded on the particular market. The indices based on a small number of stocks have the advantage of easy calculation, but the disadvantage of being imperfectly represented of the market as a whole. Index weighting. The contribution of individual stock prices to an index may be unweighted, value-weighted, or price-weighted. In the case of unweighted indices, an average of daily rates of a share price change is calculated each day. This is an average of stocks on one day. The product of such changes, since a base date provides the index. The calculation involves 2 stages. One is averaging stock price changes on a single day. The other involves compounding the daily averages over time. The calculation gives all stocks equal influence irrespective of the sizes of the companies. To illustrate the calculation of an unweighted index, suppose that it is to be based on just 3 stocks whose prices and numbers of shares issued are shown in Table 7.1. The changes relate to just one day. It is further supposed, A, that stock A rises by price of 15% during the day while the other 2 prices remain unchanged, and B, that stock C undergoes a 15% price rise while the other 2 prices remain constant during the day. Before the price rise, the index equals 100. In the event of a 15% rise in the price of A, the new index will be shown by the figure below. Page 133. It can be seen that a 15% rise in either stock price has the same effect on the index despite the fact that C has a higher stock price and is issued by a larger company. Price-weighted indices weight percentage price increases by the initial stock prices. The index at time t can be calculated as follows. Sum of stock prices at time t over sum of stock prices on the base date times the base value. Calculations using the data in Table 7.1 and 15% price rises for stocks A and C respectively, but based on a price-weighted approach, produce the following indices. It can be seen that the impact on the index is 4 times as great as when the price rise is in stock C rather than stock A. This reflects the fact that stock price C is initially 4 times stock price A. So stocks with high prices have the greatest influence on the index. Using the same example, but calculating a value-weighted index may be based on the following formula. Index at time t equals the sum of market capitalizations at time t divided by the sum of market capitalizations on the base date times the base value. Using the figures from the previous example, a 15% increase in the price of stock A raises the index from 100 to 103, whereas a 15% increase in the price of stock C raises the index to 106. The impact of the rise in stock price C is double that of the rise in stock price A. This reflects the fact that the initial market capitalization of C is twice that of A. When indices are value-weighted, large companies have the greatest influence. Some indices, rather than using the full market capitalization, use the value of shares available to investors in the free float. This alternative excludes shares held by the issuer and not available for purchase by investors. All the calculations thus far have used arithmetic means. It is interesting to repeat the calculations using geometric means. The computations and resulting indices are as follows. Unweighted, A and B. Price-weighted, A and B. Value-weighted, A and B. The unweighted, price-weighted, and value-weighted computations produce identical results. The results are the same irrespective of whether the 15% increase is in the price of stock A or in the price of stock B. Page 137. Adjusting for changes in the constituent stock of an index. In most cases, the constituent stocks in an index are changed as some firms grow and others experience relative decline. For example, every 3 months, some companies are removed from the FTSE 100 index and replaced by others in order to ensure that the index remains close to covering the largest 100 firms by market capitalization. Such changes in the composition of the index portfolio should not affect the value of the index. Since they do not result from overall market movements, this requires adjustments to the formula used for calculating the index. Suppose that a value-weighted index stands at 1,120 and is based on the 3 stocks in Table 7.2. Please continue reading to page 144. Chapter 8, The Rationale and Conduct of Regulation, pages 145 to 160. Investments can be missold. There can be malpractice and misrepresentation. These could arise from inadequate training of advisors or from conflicts of interest. For example, if advisors are paid by commission, they may be inclined to sell the products that pay the highest commission rather than the products most suitable for the needs of their clients. Major source of possible malpractice is asymmetric information. The supplier of an investment product knows much more about it than the consumer does. Full and accurate information could be withheld from the consumer. The economic rationale for regulation can be described under 3 headings. The first is the need to correct market imperfections. The second relates to the existence of economies of scale in monitoring the suppliers of financial products. The third involves the establishment and the maintenance of consumer confidence in the market by ensuring that suppliers do not fall below the specified standard. Correction of market imperfections. There are numerous potential imperfections in the market for retail financial products. A perfect market requires all participants to have full information. Consumers of financial services typically lack full information. It is difficult to ascertain the quality of financial products at the point of purchase. The technicalities of many products render them difficult to assess by consumers. Many financial products are long-term in nature. The realization that a poor product has been bought does not occur until it's too late. There is a temptation for consumers to take a free rider approach, whereby each consumer assumes that the other consumers have investigated the soundness of a product and their providers. There may be a temptation for commission-seeking sales personnel to distort the information provided to the consumers. Many financial products are not purchased frequently, with the result that consumers do not develop knowledge of products and providers. One purpose of regulation is thus the imposition of requirements upon providers in relation to the provision of information to consumers. This regulation should encompass not only the provision of adequate and accurate information to consumers, but also the ability of sales personnel to communicate such information. Financial advisors should not only provide high-quality information, but should be able to understand the information that they give. It is possible for poor advice to be given as a result of the advisor failing to fully understand the product being offered. Economies of scale and delegated monitoring. In the absence of regulation and supervision by an agency, consumers would need to investigate and monitor the providers of financial services. This would require time, effort, and money on the part of the consumers. This would entail considerable duplication, as all consumers would be carrying out the same process. There would also be the loss of economies of scale derived through a specialist regulator acquiring expertise by means of carrying out investigation and monitoring on a frequent basis. In the absence of such a regulatory agency, many consumers would find the investigation and monitoring of firms beyond their level of expertise or resources. Consumers might be tempted to take a free rider approach wherein each assumes that the other consumers are carrying out the investigations and monitoring. Each individual consumer is unable to derive the full benefits of their own supervision, since the benefits would occur to all consumers. Meanwhile, the costs of investigation and monitoring are likely to be disproportionately high for any individual consumer who chooses to carry out the supervisory function. Since there are high costs involved in investigating and monitoring the providers of financial services, it is rational for consumers to delegate some of the supervisory role to a regulatory agency. The rationality of this is reinforced by the economies of scale in regulation and by the desirability of spreading the cost regulation among all those who benefit from it. This rationale is a variation on delegated monitoring theory. Confidence and minimum standards. The theory relevant to this point is known as Akerlof-Lemon's paradigm. If consumers know that there are good and bad products on the market, but do not have enough information to distinguish between them, they may decide not to buy in order to avoid the possibility of finding that they have bought a bad one. In this way, the existence of substandard products can reduce the total level of demand in the market. When consumers know that there are low-quality products in the market, good products may become tarnished by the generalized reputation of poor products. One role of regulation is to set minimum standards, and thereby remove substandard products from the market. Suppliers would also have an interest in regulation, which enhances consumer confidence by eliminating the possibility of low-quality products. It is doubtful whether such confidence can be created without formal regulation. There would always be the risk that unscrupulous firms would attempt to exploit the confidence created by reputable firms. The chance that some providers of financial services will fail to abide by an informal agreement about minimum standards would disincline the honest providers from abiding by the agreement. Indeed, firms that abide by such agreement, when other firms do not, may put themselves at a competitive disadvantage, particularly if the maintenance of a good standard entails additional costs and hence higher prices. Please continue reading to page 160. In Objective 3, you will read pages 163 to 201 of Chapter 9, and then turn to pages 225 in Chapter 11 and read until page 232. Chapter 9, Mutual Funds, Unit Trusts, OICs, Investment Trusts. Benefits of mutual funds. A major form of institutional investment is the mutual fund. Mutual funds come in many varieties. In the United Kingdom, there are 3 broad types. These are investment trusts, unit trusts, and OICs. Open-ended investment companies pronounce OICs. Some people prefer to restrict the term mutual funds to unit trust and OICs. But this is just a matter of semantics. Similar instruments exist in other countries, but often with different names. These forms of collective investment have both similarities and differences. All forms of mutual fund allow investors to have spread of the investments for small money outlay. For example, £1,000 can buy part of a fund which contains more than 100 different shareholdings. In this way, small investors can enjoy a risk reduction benefits of a well-diversified portfolio. Stockbroker commission costs would render the acquisition of a large number of different shareholdings impractical for small investors. The returns from mutual funds come in 2 forms. One is the dividend income from the investments, and the other is the increase in prices of the investments. There is a risk price that falls, but diversification reduces this risk since, to some extent, losses on some investments will be offset by gains on others. Mutual funds provide other advantages to investors. They provide administration of the investments on behalf of investors. For some, dividends could be automatically reinvested on behalf of the investors. They remove the need for investors to ascertain which shares or bonds to buy. The choice is made by professional fund managers. However, these services have to be paid for by annual fees taken from the dividends. And it is controversial as to whether the investment choices of professional fund managers are, on average, superior to random stock selections. Mutual funds permit a choice of investment strategy. There are general, high income, and growth funds. There are funds that focus on asset classes, for example, funds that invest exclusively in bonds. Many funds allow for particular geographical orientations. Differences between unit trust, investment trust, and OICs. A unit trust is a fund managed by a bank, insurance company, or investment company. Individual investors buy units in the fund. An investment trust is a company whose purpose is to invest in other companies. Individual investors buy shares in the investment trust company. An OIC is a company whose purpose it is to invest in other companies. Individual investors buy shares in funds operated by the OICs, but these shares are similar to the unit sold by unit trusts. An investment trust is a board of directors which decides on broad investment strategy and objectives. The implementation of the strategy and objectives is normally carried out by an investment management company. A unit trust is constituted by a trust deed. The unit trust manager is responsible for the day-to-day operation of the fund. Each unit trust fund has a trustee, which must be independent of the manager. The role of trustee is normally taken by a bank or insurance company. The trustee is custodian of the assets, maintains the register of unit holders, and generally oversees the management of the trust fund. The trustee has the role of protecting the interest of unit holders and ensuring that the managers do not stray from their stated objectives. The managers are able to advertise and market unit trusts directly to the public. The funds are exempt from capital gains tax. Instead, such taxes are payable by unit holders whose individual capital gains exceed the personal exemption limit. UK authorized unit trust investing in equities can hold no more than 10% of the fund in any one company, and no more than 10% of the issued capital of the company can be held. Unit trusts are open-ended. The purchase or sale of units by individual investors causes the fund to expand or contract. Likewise, the number of units increases or decreases. The transactions are carried out with the investment manager. OICs are similar to unit trusts in these respects. Investment trusts are closed funds. The purchase or sale of shares by individual investors has no effect on the size of the fund. An unchanged number of shares change hands. Transactions are carried out with other investors through the medium of stock exchange. In the case of investment trusts, day-to-day fluctuations in demand are reflected in moving share prices. By contrast, unit trust managers regularly issue new units or buy back existing ones in order to accommodate fluctuations in demand. Please continue reading to page 201.